Everyone, and welcome to This Explainer. Okay, so June 25th, 2026, it was honestly one of those really rare days that perfectly captures this massive paradox we sometimes see in the global markets. On paper, it absolutely should have been a nail-biter of a day. But instead, it turned into this absolute domestic powerhouse of a trading session. So let's find out exactly why. This is the exact mystery we're unraveling today. Because if you were watching the global boards that day, honestly, you just saw a sea of red. Just a whole lot of hesitation everywhere. Wall Street was mixed, Asia was looking pretty unsure, and Europe was treading incredibly carefully. But then you pan over to India, and bam, the indices are just surging. So what's with the massive disconnect, right? How did the domestic market manage to completely shrug off all of that global anxiety? Well, to figure this out, we're drawing our map straight from the Prudent Morning Coffee Report that came out that morning. Let me tell you, it is an absolute goldmine of macroeconomic data, institutional flows, and market indicators. It basically cuts right through all the daily noise and just lets the actual hard numbers tell the real story. And honestly, here is the punchline of that story right up front. 76,991. That is exactly where the BSE Sensex closed, locking in a really solid 1.04% gain for the day. And the Nifty 50 wasn't far behind, jumping 0.83%. Now, in a global environment that was essentially hitting the panic button, seeing this kind of upward momentum, that's a huge deal. Domestic investors were clearly latching onto something incredibly positive, something that completely outweighed all that international static. It was basically a tale of two mindsets. On one side, you had extreme global caution. I mean, the US markets were sweating out a bruising tech sell-off, investors were biting their nails over upcoming inflation data, and there was this deep looming anxiety about the Fed hiking rates again. But on the flip side, pure domestic optimism in India. Investors here were pricing in easing geopolitical tensions, a really supportive Reserve Bank of India, and these growing hopes for a major US-India bilateral trade agreement. It was essentially the perfect storm of positive domestic vibes acting like an impenetrable shield against global headwinds. Section 1. Decoding the market drivers. The domino effect. Okay, so it's like a giant puzzle, and it all started thousands of miles away. Tankers that had been totally stranded in the Gulf because of the Iran conflict, they finally started transiting through the Strait of Hormuz. Because that huge supply bottleneck suddenly cleared up, global crude oil prices absolutely plummeted by roughly 7%. Toss in that background optimism about a US-India trade deal we just mentioned. Then, the RBI sees this drop in oil, realizes the pressure on inflation is easing up, and decides to pause their rate hike discussions. Finally, investors see all these green lights, and they just go for it. Markets surge. It is literally a textbook example of macroeconomic cause and effect. Section 2. Commodities and currency shifts. So let's look at those commodities, because across the board, they took a massive hit that week. Brent crude went down almost 7%, silver took a staggering dive of nearly 10%, and gold dropped over 6%. This massive sell-off was the direct result of those easing tensions in the Middle East. And here's the kicker. For a country like India, which imports a massive chunk of its oil, a 7% drop in Brent crude is huge. It acts almost like an immediate massive tax cut for the entire economy. Right. So, with global oil suddenly way cheaper, India's import bill shrinks fast. Less money flowing out means less imported inflation, which ultimately takes the pressure off everyday prices for all of us. And you know what else happens? It immediately strengthens our currency. On this specific day, the Indian rupee actually rose against the US dollar to 94.70. And a stronger rupee, that gives foreign investors a lot more confidence and hands the central bank a ton more flexibility. Which brings us to Section 3, the RBI rate pause. Premature. That was the exact word that absolutely set the trading floors on fire. The RBI governor explicitly came out and said it was premature to discuss rate hikes. He pointed out that the central bank was going to wait and assess the second-round impact of those lower crude oil prices on broader inflation first. By just dropping that one word, premature, the RBI signaled a really patient, supportive monetary environment. So while the US Fed was out there terrifying everyone with rate hikes, the RBI effectively told Indian investors, hey, relax. We aren't going to hit the brakes just yet. And if you want to know exactly how the market reacted to the RBI, we just have to peek at the bond market. The yield on the 10-year gilt, which is basically the benchmark government bond, fell 6 basis points to hit 6.78%. Now, to translate that jargon, when bond yields fall, it means bond prices are rising, which proves the market absolutely believed the RBI. Investors were happily pricing in a stable interest rate environment, which makes equities, like the stocks driving the Sensex, so much more attractive. All right, moving to Section 4, the money trail in mutual fund landscape. Tracking the year-to-date flows paints a fascinating picture of who actually owns this market right now. Foreign institutional investors, the FIIs, have pulled out nearly 280,000 crore rupees. Now, historically, a foreign sell-off of that sheer magnitude would have completely cratered the Indian market, no question. Yet domestic institutional investors, our DIIs, have pumped in a staggering 448,500 crore rupees. That is domestic money, largely driven by everyday retail investors pooling their savings into mutual funds, and it is single-handedly overpowering the foreign exit. They are literally keeping the entire market buoyant. And this domestic money isn't just being parked anywhere safe. It is heavily targeting growth. Think about this. Large cap funds are actually down 1.41% over the last year. The real action is all happening in mid and small caps. Small cap funds returned 8.73% over the last year alone, and if you look at a 3-year horizon, they're returning over 18%. Domestic investors have this massive appetite for growth right now. They're totally willing to take on the risk of smaller companies because fundamentally, they're deeply optimistic about the underlying Indian economy. And just to round out the mutual fund landscape, there's actually an interesting regulatory update. SEBI proposed a new rule allowing celebrity endorsements for mutual fund brands, but with a catch. They strictly prohibit celebs from pitching specific mutual fund products. Plus, the asset management companies have to foot the bill for these ads themselves. So, while we might see our favorite actors pitching the general idea of investing, they won't be out there hyping up specific highly risky funds. It's a smart move. It makes investing a lot more approachable for everyday people while keeping personal portfolios fully protected from celebrity hype. So we've seen exactly why the market rallied so hard on June 25th. We followed the domino effect from cheaper oil to a patient RBI, right down to this absolute tidal wave of domestic investment. But the core tension is still right there in front of us. With global tech looking pretty shaky and foreign investors consistently pulling their money out of the country, here's the real question we have to ask. Can the sheer, undeniable force of this domestic optimism actually keep the Sensex soaring in the long run?